You tell them I'm coming, and hell's coming with me, you hear? Hell's coming with me!
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to it, folks. The podcast is a little bit late this week. We had some technical problems with some corrupted data and other wonderful things, so apologies for being a few days late. As you all know, I am a real estate broker. I am a real estate broker right here in Silicon Valley, based out of Morgan Hill, California. If you have any questions or suggestions or ideas or feedback that you'd like to give relating to what we talk about on these podcasts, you can reach me at soldbyrobert.com. So feel free to check that out. I also offer tools for you to get a free online estimate of your home's value and also to start your home search no matter what your goals might be. Okay, let's go ahead and jump in. Today's topic, it's about lending, it's about mortgages, and where are we going to be going from here? Right now, we are seeing some amazing trends in lending that I think are also going to play into what we might want to talk about in terms of home prices, right? Because those two things tend to go hand in hand, because the money you're going to use to buy that house is the mortgage, right? You're going to be paying someone to borrow money so that you can buy that house, and the costs of doing that obviously are going to influence what you can afford to spend, because you're going to have to fit in with that monthly budget. But some recent news that I thought was really good to cover. Headline from CNBC: mortgage demands fall slightly even as rates slip from recent highs. Right now, we are seeing that there are other factors here. We've already sort of reached this saturation point with interest rates on mortgages, and now the other part of the equation needs to give way. And what's the other part of that equation? Well, as I kind of alluded to a minute ago, it's going to be house prices. But let's go ahead and get a good handle on what's happening with rates right now. Mortgage rates dropped for the first time in more than 2 months, but the demand continued to weaken. So even in the face of some reductions in interest rates, we still saw declines in the number of people who wanted to go out and get those loans. The average contract interest rate for 30-year fixed-rate mortgages with conforming loan balances, $647,200 or less, decreased to 7.06% from 7.16%. So a full tenth of a point drop in the number of applicants at that rate. Mortgage applications to buy a home fell 1% for the week and were 41% lower year over year. So what is it how do we explain this? And the reason why I think this is an important thing to keep in mind as we move forward as buyers, sellers, or investors in this marketplace is that the thing that needs to give way now are home prices. Interest rates can't go lower from where we are today, right? As we've talked about in previous shows, if you're going to fight inflation, you have to raise interest rates. We're going to see what's going to happen in the coming days. What is the Fed going to do with interest rates? I can pretty much guarantee you it's going to be at least another 0.75 increase in the prime rate. My guess is they may even go ahead and do a full 1% increase, simply because the last time they did a 0.75 increase, we did not see that stop growth in inflation really at all. So I think we need more, I hate to use the word need, but in order to work through this problem, in order to take the medicine that tastes terrible to try to fix inflation, since the government's not willing to do the other side of the equation. We've talked about this before as well. The only place they seem willing to make these changes are on the side of the equation that tends to land on your back and my back, right? Through interest rates. They're not cutting spending, which would help reduce inflation. They are not stopping printing money or reducing the amount of money that they're printing. They are not buying back enough debt to really put a dent in this. So the bottom line, it feels an awful lot like what we're going to have to see is 10% plus interest rates before we can start to get a handle on this. And even that may not do it. We are in such a hole that we really need to be at that level in order to knock it down. I'd much rather have them exercising these other options, but the Fed raising interest rates seems like the only thing that they're actually willing to do, and primarily because that ends up landing on you, right? Okay. So where do we go from here? If we're seeing that buyers are stepping back and saying, even with a slightly reduced interest rate, I'm still not interested in borrowing. It's not going to work. I can't buy the house that I want or need at the price point that I can afford given interest rates or that I want to pay, whatever the logic is, right? However the math is working, the next thing that has to give way is home prices. And man, is the stage set for a drop in home prices. But again, let's fully survey the current situation as it relates to mortgages. Now, again from CNBC, Wells Fargo mortgage staff brace for layoffs as U.S. loan volumes collapse. This is again from today. Mortgage volumes at Wells Fargo slowed further in recent weeks, leaving some workers idle and sparking concerns that the lender will need to cut more employees as the U.S. housing slump deepens. The bank had about 18,000 loans in its retail origination pipeline in the early weeks of the fourth quarter, according to people with knowledge of the company's figures. That is down as much as, get this number, 90% from the same time last year, when the COVID pandemic-fueled housing boom was in full swing. Employees are on edge after the bank began cutting workers in April, and internal projections point to more departures. So this is where they are. This is not seen as a transitory thing or something that you can push off over a few months. This is something where they're looking at layoffs because of how long they think this is going to last. I'm not hearing from anyone, regardless of what industry they're in, that folks are heading into 2023 with a lot of optimism. We are, in a topic we discussed in a past podcast, what we're tending to see is hiring freezes and job offers that were extended being withdrawn, not expanding, not adding workers. This is what ends up feeding a scenario that deepens a recession. And as these companies tighten the belt, it actually tends to push a recession further along, so that's what we will end up having to live with and deal with. Now, here's the contradiction. When you're trying to fight inflation, you raise interest rates. When you're trying to fight a recession, you lower interest rates. So right now, the closest, biggest problem is inflation. So yes, interest rates have to go up. But as we're seeing in the real estate market, even a slight pullback on interest rates isn't kicking buyers into purchasing. And they have plenty of homes to choose from, at least here in our markets in Silicon Valley and the Bay Area. But they're not jumping on that bandwagon to take advantage of those lower interest rates compared to what they were just a week or two before. Small improvement in rates has little effect on mortgage volume. And this is a very interesting chart I thought we could share here. So interest rates, 30-year fixed, 7.08%. Refinance index way down there. Obviously, nobody wants to refinance given what rates are currently at. And then the purchase still continued to drop. And look at that. Not only did it not go up, it dropped. The blue lines are the actual purchases. This is the interest rate. So at that 7.8, it's down at, the purchase index was down at 160.4. And it went, and just over the course of a few weeks, it went from 174 to 160.5. So these are not small changes by any means that we're looking at here. So where do we go? This is the reality. This is the loan reality. The one other thing that you can do is get an idea of what mortgage rates are currently doing in your area. Let's go ahead and now compare and let's just see what might happen in our local areas. This is currently set for Morgan Hill. We'll go a target home price of $1.2 million, which is about the average of what we're seeing, I believe, right now in Morgan Hill. So these are the loans right now, this minute, for a 30-year fixed loan that we're seeing. 6.875 is the lowest, 7.625. This is the lowest monthly payment, obviously, $6,832 with 20% down on a $1.3 million home. And then it just goes up from there, 7.6, 7.7. So these are the real truth on the ground rates that you are likely going to get, particularly if you're looking in this area. Let's see if we see a change in San Jose. And in San Jose, if you were having a $1.3 million purchase, 6.875, 7.6, 7.7. So the same sort of numbers. So in terms of real numbers, these interest rates are are just insane. So how does this play out? What does this do to us as buyers, sellers, and investors? Now, what we're seeing is that despite what's happening with lending, despite brief moments where interest rates come down a little bit, buyers are not jumping on board. So what is the other element that will influence this? And that is absolutely home prices. And we talked about this a little bit earlier in today's show. But if we look at the inventory numbers, inventory has been growing steadily across the board. We are not seeing declines in inventory. So with the pressure that this is putting on the market, where buyers not willing to make the purchase, not at these interest rates, and when we see in all of the communities we check, whether it's Santa Clara County in general, or San Jose, or Morgan Hill, or Gilroy, or San Martin, or Los Gatos, all of these areas where inventories are continuing to grow, ultimately there comes a point where the only factor that can really be changed is home prices. So I think that we are heading into a period, and I mentioned this on a previous show. I think the new year we're going to see some definite adjustments relating to sales prices. We've already seen some communities really cranking out price reductions. Gilroy was really one of the first places that for 2 months in a row has seen in August, we saw over 40% over 40% of listed homes had a price reduction. September over 40, I think it was 47% in September for Gilroy, for instance, had price reductions. We have price reductions in Morgan Hill. We have price reductions in San Jose. All of these areas are experiencing price reductions, some to greater extents than others. But as this reality sinks in, where not even a slight decrease in interest rates for mortgages gets more buyers into the marketplace, the only other factor that's going to do this is going to be prices. So, and the areas that are going to be hardest hit are probably going to be relatively mainstream homes, the average priced homes and average plus, say, 10% priced homes. So these are times when, if you're a buyer, the best advice I can give to you is to hold off. I would wait. I would go through the winter months. This is the same advice I've been giving now for a while. Just fasten your seatbelt. I would suggest that you start subscribing to lists that give you updates on homes that list in areas you're interested in, so that you can get a feel for what's being listed, how long they're on the market. When they do tend to sell, what do they tend to sell for, the list price or less, or the list price or more? It's going to calibrate you to what to expect when you jump in as a potential buyer. For you sellers, again, if you can fasten your seatbelt and weather this out, that's the option I think you should go for. It's also going to depend very specifically on where your home is located. As is true in all cities, there are submarkets, and there are some areas in San Jose, Morgan Hill, Gilroy, where this is not as much of a phenomenon, where demand is still higher, where if folks are going to buy, they're going to buy there first. So it's about smart buying, right? And this is a topic we've talked about before, where I always like my buyers to put on their investor hat, because you want to try to pick properties that carry enough benefits with them that even when things start to go for a downturn, that property will be the last one to be impacted the hardest, right? So and that's where we are right now. But I think we run out of those areas, even the areas that are remaining desirable, because I'm starting to see listings come up in areas that are considered desirable, that are staying on the market longer. So I hate to have the general suggestion be just fasten your seatbelt and hold on, but I think for a lot of us, that's really the smartest path. If you are a person who owns a home that was thinking about selling anytime in the next year or two for whatever plans you might have had, I strongly suggest you reevaluate your scenario, figure out where you are in terms of your home's value in your current market, and figure out if selling now makes more sense before we start to see more downturns. Because even properties that are in super desirable areas, I think, are going to tend to see, at the very least, a slowdown, which would equal less appreciation as you move forward, and longer days on market. But we're also going to see declines. We're in a lot of areas where it's going to shock you. We're going to see property values going down when compared to the same time last year. All right. So I hope this has been useful. Mortgages right now are so depressing, and particularly for buyers. I have an awful lot of folks who are buyers searching for a home who have just been finding themselves steadily priced out of the market, not because of home prices at this point, but because of what their mortgage payment would be based on current interest rates. So then there are absolutely still opportunities out there. It really depends on how flexible you are on where you want to live. But right now, with things in such flux, I would say get yourself ready to make a move and wait for the circumstances that come along that make sense for you to actually pull the trigger. All right. I hope that has been useful for everyone. The goal is always to leave more information on the table than I take up in your time. I hope we have succeeded at doing that today. Thanks again for listening, and I'll talk to you all next time.